This shows a massive 64% drop in operating profit for Mercedes-Benz, not during a recession, but a global luxury boom. While those numbers bleed, Chinese investors quietly sit on nearly 20% of the company's shares, waiting in the shadows. To understand how a legendary automaker maneuvered itself into this trap, we have to look back at the illusion of 2022. That year, Stuttgart reported over 300,000 vehicles sold and 20.5 billion euros in profit. Wall Street analysts were left speechless. CEO Ola Källenius made a bold call. Mercedes would stop building cars for everyone, focusing only on objects of desire. This pivot meant pushing prices up by an eye-watering 43%. On a spreadsheet, the math looked flawless, but Mercedes confused luck with strategy. Those record profits were actually a byproduct of the global chip shortage. A fractured supply chain meant fewer cars were built. That scarcity artificially drove up transaction prices across the board. The numbers hid a severe lack of organic, real-world demand for this new pricing structure. When the global supply chain finally normalized, the math broke. Production resumed, but the eager buyers for six-figure cars simply were not there. Stuttgart had diagnosed a temporary logistical bottleneck as permanent market validation. They engineered their own financial trap by betting their entire future on an anomaly. Instead of adjusting course, Mercedes doubled down and released the EQS. Intended as the ultimate electric luxury sedan, engineers obsessed over a single metric, molding the car to achieve a world record drag coefficient of 0.2. The aerodynamics were mathematically impressive, but the shape was a disaster. The six-figure flagship looked like an inflated piece of candy, devoid of road presence. When buyers look for a Mercedes, they expect a commanding silhouette. They want the heavy, aggressive lines that define the brand's heritage. Customers looked at the new electric flagship and declared it wasn't a real Mercedes. This line graph tracks that rejection. In the US market, the EQS lost 48% of its value within 12 months. Half the purchase price, gone. True luxury goods, like a Rolex or Hermes bag, retain their worth as investments in enduring desire. The EQS depreciated faster than a wrecked used car. It possessed excellent aerodynamics, but it completely lacked the emotional soul required to sustain high-end pricing. You cannot program prestige. By prioritizing mathematical efficiency over the intangible feeling of luxury, Stuttgart instantly erased half of their flagship's value. But the miscalculation extended beyond the electric transition. It struck the final, most passionate bastion of the brand, the high-performance AMG division. For decades, the AMG badge stood for an emotional promise, delivered through a legendary, roaring V8 engine. Then, the new C63 arrived. Engineers ripped out that V8, replacing it with a highly efficient four-cylinder hybrid powertrain. The engine is an absolute technical masterpiece. It's also an engine that absolutely nobody asked for. When a customer drops six figures on a performance car, they aren't paying for fuel efficiency or logical hybridization. They are buying a visceral reaction. The crackle of the exhaust, the heavy vibration of the block. It's an emotional purchase, driven purely by feeling. Mercedes systematically engineered that feeling out of the vehicle. In response, their most loyal customers simply walked out the door. The spreadsheets showed a brilliant path to modernization, but the real world rejected it. Stuttgart has stripped their own identity bare, walking willingly into a trap, while foreign investors quietly wait to pick up the pieces. While Mercedes management focused on refining the EQS and the four-cylinder AMG, a much larger threat was developing in the East. Their true vulnerability didn't lie in a single model, but in their absolute reliance on the Chinese market. China had become the group's primary life insurance policy, accounting for over 36% of all Mercedes vehicles sold globally. The profits generated here acted as a financial shield. This massive stream of capital funded the company's dividends and its transition to electric power, while effectively masking management errors in Europe and North America. But that financial shield was brittle. A completely new generation of wealthy Chinese buyers began to shift their perspective, increasingly viewing the Mercedes badge as an outdated relic rather than a modern status symbol. By treating China as an infallible source of revenue, Mercedes created a massive strategic blind spot. Their greatest financial fortress was being transformed into a deadly liability. Domestic competitors like BYD, NEO, and Xiaomi began to dominate the local market. These aren't low-cost alternatives. They are high-tech rivals innovating at a pace that has blindsided the German establishment. The disparity is best seen in the development cycle. While it takes German engineers up to 5 years to bring a car from sketch to showroom, Chinese manufacturers are completing that entire process in just 24 months. That speed translates to technological advantages. These domestic models feature software suites that integrate deeply with the local mobile ecosystem, making the digital interfaces in a Mercedes look slow and disconnected by comparison. This focus on software-led luxury extends to highly advanced autonomous driving capabilities, managed through intuitive, multi-screen interiors that cater to a tech-native audience. Most critically, these domestic manufacturers are offering these digital features at a price point that makes the Mercedes EQS look remarkably overpriced. As a result, Mercedes is struggling to keep pace with the shifting definition of luxury in the world's largest automotive market. Legacy luxury brands like Rolex or Ferrari operate on a simple rule: maintain prestige through scarcity. They don't offer clearance discounts, and they never hold fire sales. Mercedes broke that rule. In a bid to remain relevant, they slashed the price of their flagship EQS by $30,000 overnight. This decision had immediate psychological consequences. Customers who purchased the car just days earlier watched their equity vanish, severely damaging the brand's premium aura in the eyes of the public. The financial fallout was even more severe. Operating profit in the passenger car division collapsed by 64% as margins were sacrificed to maintain volume. This wasn't a slow decline. That massive drop in profitability occurred over a window of just 3 months. By betraying their own luxury identity out of desperation, Mercedes effectively canceled their financial life insurance, leaving the company exposed to further shocks. By the spring of 2025, a second crisis erupted in the West. Washington introduced heavy import tariffs, signaling a shift toward penalizing imported vehicles. Even after the initial shock, a unified 15% rate was established. For European automakers, the message was clear: shipping goods into the North American market would now carry a heavy penalty. This policy targets the core of the Mercedes business model. They rely heavily on exporting European-built vehicles to buyers in the US and Canada, a strategy that is now under direct attack. Every percentage point of that tariff erodes their margins, further straining a cash flow already weakened by the collapse in the East. Mercedes is now caught in an inescapable dilemma. Raising prices to offset the tariff will likely hurt their sales volume, but absorbing the 15% cost will eliminate what remains of their profit. For decades, the company relied on its historic prestige to navigate market shifts. But in a landscape of rapid technological change and rising trade barriers, that legacy is proving insufficient. Wall Street's reaction was immediate, as analysts recognized that the group's global revenue model was facing a synchronized failure on both sides of the globe. With the profit engine in China stalling and American tariffs blocking their Western margins, the funding required to bankroll the company's electric pivot has been severely compromised. The capital necessary to survive this East-West assault is being squeezed from both sides, leaving the company's financial roadmap in a state of high uncertainty. In a standard corporate crisis, the playbook is predictable. A strong company tightens its belt, pours capital into its core products, and projects stability to the market. Mercedes-Benz did the opposite. Right in the middle of its worst modern crisis, the boardroom announced a massive stock buyback. This is a form of financial engineering. By purchasing its own shares, a company reduces the total supply on the open market to artificially inflate the price. The move serves to keep Wall Street happy, creating a temporary facade of financial health to satisfy institutional day traders. This chart highlights the gap between engineered stock price and industrial reality. While the green line climbs, the core automotive business is bleeding out. This divergence points to a structural vulnerability, a gap where financial optics detach from the health of the assembly line. Choosing to exhaust cash reserves on buybacks during a product crisis suggests a leadership team prioritizing short-term share stability over long-term survival. The rising stock price functions as a smokescreen, hiding the fact that the company is effectively cannibalizing its own resources to maintain its valuation. To weather market volatility, most major automakers rely on a corporate anchor, founding families with a multi-generational interest in the company's survival. BMW is backed by the Quandt family. Figures like Suzanne Clatton act as a shield, allowing the company to ignore day-to-day stock fluctuations. Volkswagen has the same protection through the Porsche clan, who maintain a historic grip on the conglomerate's direction. These billionaire anchors provide a buffer. They allow a company to endure a bad year or an expensive transition without having to appease the immediate demands of the stock market. This chart shows the primary structural flaw at Mercedes-Benz. They have no family anchor. 70% of their shares are in free float. They are controlled by institutional investors prioritizing rapid returns. If the stock drops, these investors simply abandon ship. This explains the desperation behind the buybacks. Mercedes is forced to artificially pump its stock because it is terrified of its institutional owners fleeing. Mercedes leadership effectively functions as a hostage to its own cap table, managing a financial instrument rather than steering a car brand. Funding these buybacks requires immediate cash, and that money is being pulled directly from the company's industrial core. The company is gutting itself to save €5 billion by 2027. This involves 40,000 severance offers and canceling night shifts. They are even liquidating historic real estate in Germany to generate the liquidity needed to support the share price. These cuts lead to a death spiral of irrelevance within the global supply chain, where the brand is losing its most important asset: volume. The modern auto industry is a volume game. If you don't order in massive quantities, you lose your leverage with suppliers. Mercedes is currently ordering only 50,000 batteries at a time. Compare that to Tesla, which orders 2 million. Suppliers react to this low volume by pushing Mercedes to the back of the line and charging a premium for basic components. By trading its industrial scale for a temporary stock bump, the former heavyweight has become a beggar in its own supply chain. As the company weakens, Chinese state-owned enterprises are waiting in the wings to tighten their grip on the brand. These entities already control a fifth of the company. A trap has been set. Every time the business falters and the stock drops, it becomes cheaper for foreign interests to purchase more control. The possibility of a Mercedes-Benz that is just an empty corporate shell, powered by Chinese technology and wearing a Stuttgart badge, is a rapidly approaching reality. For investors, the takeaway is clear. It is time to stop investing based on 140-year-old brand mythology and nostalgia. Instead, evaluate auto stocks by looking at their anchors and their volume leverage in the electric vehicle supply chain. Legacy loses its utility in a market that prioritizes leverage and capital above all else. When do you think we'll see a complete Chinese buyout of the brand? Let us know in the comments and download our institutional investor cap table cheat sheet linked below.